Okay, so as you already know, it's the adjusted trial balance that we use to create our financial statements. Okay. The financial statements, the income statement, and the retained earnings statement, as you know, measure a period of time. The shortest period of time they'll measure is 1 month, right? The longest period of time they measure is 1 year. At the end of that year, we have to go through a process of closing the record, closing the books. And what we really mean by that is we want to keep track of our revenues and our expenses separately year to year. Okay. We do the exact same thing to dividends, although that's not the main concern here. The main concern is we want to make sure our records for revenue and expenses are separate every year. Okay. Now, clearly, we can do this month to month, no doubt about it. But at the end of the year, literally, what's going to happen is we need to start with zero balances everywhere. No revenue, no expenses, because we're just going to be starting a new record for a new year. And you start your new year at zero and you count from there. Okay. So, in order to do that, we have to close those accounts. Revenue accounts go through a process of getting closed. Expense accounts, all of them, go through a process of being closed at the end of the year. And the dividends account also goes through a process of being closed. In other words, they have to start at zero for the new accounting year. So that's the process we're going to be learning today. Okay. So that process is we call closing the books. And closing the books basically only affects the accounts that are subject to the periodicity assumption, which are the revenue and expense accounts, as you know, because those are on the income statement, and the dividends account, which of course is the net income, these two accounts combined, right? Minus the dividends. So those are called temporary because literally we can only measure them up to 1 year's time. And then we need to close them because the very next day represents a whole new year that we're supposed to keep separate records. Okay. And you have to start keeping separate records from zero. You can't have a balance in there from the previous year because then you're going to be mixing up years and you can't do that. So it's almost like your W 2 when you get that from your employer at the end of the year. It shows you all of the money you made in that 1 year period of time. And then that's that, right? For the very next year, they're going to keep track of your earnings separately and you'll get a W-2 form for another year. So again, it's separate years. The longest we can measure is the 1 year period. So that makes them by default revenue, expense, and dividend accounts are temporary because we can only use them for one full year before we have to close them. Then we can use them again for the whole next year. Then we go to close them. Then we use them again, year to year to year. That doesn't happen with any of the balance sheet accounts. So the balance sheet accounts never go through this process of being closed because they don't measure a period of time. Okay, the closing has to happen because we're out of time, right? We can only go for 1 year and then we have to stop. We have to close that year. And so that's why these accounts go through this process and the permanent accounts do not. So it's actually a 4-step process in preparing closing entries. And you need to look at this one step at a time. Okay, don't get overwhelmed by this, one step at a time. The very first thing we do is we close the revenue accounts. Okay, not quite. We close the revenue accounts into a temporary holding tank, temporary account that we set up called income summary. Okay. Um, After we close the revenue accounts will simply have a zero balance in them. And that's the only thing that closing does. You close to get a zero balance in the account. To get a zero balance in the account, both sides of the account must equal, right? So it's almost like you put $100 in your savings account, and then you took $100 out of your savings account. That's how you get it to zero, right? So for a revenue account, to get it to zero, we have to debit the revenue account because the revenue account has its balance sitting on the credit side. So to get that account to zero, as you'll see, we're going to debit it. We temporarily move the revenue amount into the income summary account temporarily. Again, this is simply a temporary account. So that's the first step. The second step here, as Aname was correct in putting the number 2 here, is to close every single expense account. Okay, expense accounts, every single one of them also need to be zero. And how do you produce a zero balance in an expense account? Well, expenses are, their balances are sitting in the debit side of the account, right? So what do? Well, we will credit every single individual expense account, and we're going to move those expenses over to income summary temporarily. Okay. So after we do the first 2 steps, we now have revenue sitting at zero. So it's ready to begin the new year. We have all of our expense accounts also with zero balances. And so they're ready to start a new year. Okay, so we're halfway there, those first 2 steps. The third step is we don't really need this account anymore. This income summary account really is not needed anymore because it served its purpose. It allowed us to close our revenue and expense accounts to zero. So what's sitting in income summary? Well, all the revenue is sitting there and all the expenses are sitting there. So the difference in income summary is going to be just like it is on the income statement. Your net income is going to be sitting there. Okay. Your net income is going to be sitting there. Well, it doesn't need to be there anymore because what do we do with net income? After we take all of our revenue, subtract all of our expenses, we move the net income directly into retained earnings. So the third step is we close income summary. We don't need it anymore. We close this account. The balance in income summary will be the net income because it's simply the income statement accounts that are on it. And we simply move that over to retained earnings. Now, in order to move it over to retained earnings, we're going to credit retained earnings because a credit to retained earnings means more retained earnings. And we increase retained earnings by adding the net income, which means that we're going to be debiting income summary to close it. And net income rather, is going to be sitting in retained earnings where it's supposed to be. The very last thing that we do is we close dividends directly into retained earnings. Okay, now this makes sense because on the retained earnings statement, you take away the dividends. And so the issue is that dividends are sitting with a debit side balance. In order to get the dividends account to zero, we have to credit the dividends account to get it to zero. We move the debit to retained earnings. And that makes perfect sense, right? Because when we subtract dividends from retained earnings, we have to reduce retained earnings on the debit side. So it's exactly what we do. So these are the 4 steps that you're going to be learning. And that's sort of the explanation here. This is what it looks like in the journal. All of these are journal entries because nothing happens in accounting without first putting it in the journal, as you know. So here are the closing entries that you'll need to know. This is the very first step. Close the revenue account to income summary, right? Closing revenue means zero balance. Revenue has a credit balance. closing revenue to zero means the debit side has to equal the credit side to get to zero, right? It's that exact same that I mentioned. If you have $100 in your savings account, to get it to zero, you got to take $100 out, right? So that's all we're doing here with closing. So that closes the revenue account and we're done. Step one. Step one is done. The second thing we do is we have to close each and every expense account. Now, again, there are many different expense accounts. Each individual expense account needs to be closed, which means it needs to have a zero balance in every single account. As you know, all the expenses have debit side balances in them as a normal balance. So we have to make equal credits into those accounts to bring it to zero. And we move all of that into income summary. Look what's sitting in income summary. Everything in income summary here, these two things are in income summary. This represents the revenue. This represents the expenses. Doesn't this, this is exactly what's on the income statement for Sierra Corporation. Total revenue is 10,600, total expenses is 7,740. So income summary account is sitting there temporarily now with all the revenue on one side and all the expenses on the other side. In the meantime, we have already closed our revenue and expense account, so we are halfway done with this. Okay. And again, we have to close the accounts every year. We have to make sure there's zero every year because we have to keep those records separate year to year. So the third step is we no longer need that income summary account because it's served its purpose. It allowed us to close revenue and it allowed us to close our expenses out. Okay. What's sitting in income summary is the difference between the revenue and the expenses, which is the profit and net income. If you remember from Sierra Corporation, the net income was $2,860. Right. So debiting income summary means that now income summary has 10,600 on the credit side and a total of 10,600 on the debit side, which means it's got a zero balance, which means it's closed. That net income is moved over to retained earnings. We add net income to retained earnings. Retained earnings is a stockholder's equity account. Stockholders' equity accounts increase on the credit side. So this makes perfect sense. Crediting retained earnings means more retained earnings. What are we crediting it? The net income is being credited. The difference between the revenues and the expenses is the net income, right? Net income. Okay, so after that, we're done with income summary, and now everything there is closed. The very, very last step we have to do is to zero the dividends account, close the dividends account. So dividends has a $500 balance. It's going to be on the debit side of the account, as you know. So to close it, we have to make both sides equal. So that's why we have a credit to dividends, because that means both sides of the dividends account will be equal and we have a zero balance. That debit is moved to retained earnings. And that makes sense, right? Because a debit to retained earnings reduces retained earnings. And that's exactly what we do on the retained earnings statement, right? Retained earnings statement, we add net income, we subtract out the dividends. So you can, this is how it plays out in the journal. This is how it looks in the journal. When it posts to the ledger, this is just a very nice graphic. If you like it, it's on page 177. I don't like to be so graphic with you, but here we are. Here's step one. The debit to service revenue means that both the debit and credit side are balanced, which means service revenue has a zero balance. That's moved over to income summary temporarily. Step two is we closed all of our expense accounts. In order to close an expense account, we have to make sure the credit side is equal to the debit side to allow us to have, again, the purpose is to have a zero balance. These are supposed to be zeros, I'm sorry, in every single expense account. And of course, expense accounts will have debit side balances. So we're going to put the zeros there. In the meantime, all of those expenses are sitting now in income summary. So income summary looks like the income statement. All the revenue is on the credit side. All the expenses are on the debit side. So when revenue is larger than expenses, you got a profit. The profit is 2860. Well, we don't need income summary anymore, so we can take this, close it out to zero, and we move that profit to retained earnings on the credit side because we add net income, right, to retained earnings. And the last step here, as you see, closing dividends means we're going to need to credit dividends because the balance is on the debit side. So an equal credit will give it a zero balance. Move that $500 in this case over to the debit side. The debit side of retained earnings shrinks retained earnings. Now look what we got for retained earnings. A zero balance to start. We added the net income of 2860. We subtracted out the dividends of 500. The retained earnings balance at the end of the month, 2360. That is exactly the same numbers from the retained earnings statement that you saw just a few pages ago. Okay. So again, income summary account is going to look like your income statement, total revenue, total expenses. The remaining piece is the profit, net income. That gets added to retained earnings. Retained earnings is going to be, you know how this works, beginning balance plus net income minus dividends is your ending balance in retained earnings. So it's going to look exactly like the statements do. Okay. So after we do all the closing entries, we should have zero balances in all of our revenue accounts. We should have zero balances in all of our expense accounts. And dividends should also have a zero balance. To make sure we have zero balances, we do something called a post-closing trial balance. And a post-closing trial balance should tell us that all of those accounts, revenue, expense, and dividends accounts, have a zero balance. Okay, that's it. So all it's going to be on that is your assets, liabilities, and equity accounts will have balances. Dividends, revenue, and expense accounts will have a zero balance. You won't see any balance. Look at everything we've done in chapter 3 and 4. This is the entire accounting cycle that we just completed. Chapter 3, we analyzed transactions, we journaled, we post them in the ledger, and we created a trial balance. That was all chapter 3. Everything you did in chapter 3. Look how much we did in chapter 4, right? Adjusting entries, adjust the trial balance, financial statements, closing entries, and then you just saw or just learned about what's called a post-closing trial balance. All of this is chapter 4. This is the entire accounting cycle. And as you see, it's taken quite a while to learn it for a reason. It is complex, but once you practice and get used to this, I think you're going to be quite good at it. So again, this just kind of goes through step by step, all those things that we just went through, chapter 3, chapter 4. Okay, so in the post-closing trial balance, this example here, which is the bottom of page 178, you'll see after you do your closing entries, which was that last thing that we did, all those closing entries. You will see the post-closing trial balance will simply have your asset, liability, and stockholders' equity accounts. Your dividends account, your revenue account should show zero balances. Okay. All right, and so we're going to get to our do it exercise here for this last part, which is simply to do closing entries. It's the exact same 4-step process that we've outlined. Okay, and remember, the only accounts that go through this are the temporary accounts, the accounts that we must close at the end of the year. We must bring their balance to zero. Revenue, expenses, and dividends. No other accounts go through it. So here we have Hancock Company, and they have a bunch of balances here from their adjusted trial balance. Now, it gives you a whole list of things. The first thing we need to do here, it says, prepare the entries to close the revenue, which is the very first thing that we do. Expense accounts is the second thing that we do. So your first thing is to identify the revenue account. So here's your service revenue. This $98,000 would be on the credit side of the account. Would you agree? So in order to close it, you're going to have to debit your service revenue by 98,000. That brings that to zero. And credit your income summary because you're moving that revenue all the way here. Then you have to look for the second step, which is all your expenses. So we have an expense here, we have an expense here, and we have supplies expense right here. So those three expense accounts need to be closed, right? Expenses will have all their balances are going to be on the debit side. So each of these accounts need to be brought to zero on the credit side. The total is going to go to income summary. And so what you show here in the book is your income summary has the total expenses. This 80,000 is the total expenses. Okay, just like this 98,000 is the total revenue. Each individual expense account is credited to bring its balance to zero. Okay, so step one, close revenue account to income summary. Step two, close each individual expense account and move the total to income summary. What's in income summary now is the total revenue and the total expenses. So you can just know this is part of their income statement. You know what Hancock Company did this period. They had 98,000 of revenue, 80,000 of expenses. They had an $18,000 profit. You can know that just by looking at those two, because whatever's in income summary is what's on their income statement. So the third thing we had to do is then the third step is to close income summary. And the fourth step is to close dividends. Okay. So to close income summary, we have to look at the previous slide, which showed that there was $18,000 profit sitting there. Well, the third step is to close income summary with a debit that makes both sides balance to zero and move that to retained earnings. A credit to retained earnings is exactly what happens with net income. We add net income to retained earnings, so the credit to retained earnings makes perfect sense. Okay. And the very last thing we do is close dividends. This is our dividends account. $15,000 is sitting there. It's sitting on the debit side. To close dividends means to bring the balance in the account to zero. So we're going to have to credit dividends by this amount and move that debit to retained earnings. So the very fourth thing we do, debit retained earnings by the amount of the dividends, close dividends to zero with the credit. So this is step 3 right here. This is step 4 right here. Notice that there are some accounts that are listed up here that you didn't use. Accounts payable is not used. Accounts payable is a liability account. A liability account is a permanent account. It does not go through the closing process. So we can ignore that. You probably also realize accounts receivable is an asset account. Asset accounts do not go through a closing process. Asset accounts are permanent accounts. They're not temporary. So we can ignore that. Okay. And you're done. Not bad. That's the last step. The closing process is the very last step. How'd you do? Any questions?